So these, which we need to be look around costs such as the waste, however, this type of, the standard result, adverse variance, and we can look around these, is very crucial. Okay, demotivate, sometime it can be feel the standard can demotivate where there is no value. Attainable standard, also achievable standard, assume the efficient level of operation which allows factors such as the losses of the waste, the machine, or the downtime time, and negative motivation impact on make an allowances unavoidable. Current standard, which is based on the current performance, current wastage, and inefficiency. In a current standard, disadvantage, this don't encourage attempt to improve. Sometime or 10% fluctuation less will use, will carry on doing what we are doing. Reconcile your actual performance and the contribution and the budget, which we can look around the variance. So reconciliation state the profit reconciliation. So where we have a positive and negative, adverse and favorable, we can add up what impact you have, what impact on the material usage, what impact on labor efficiencies, and so on. So we can look around what impact on the profit is vice versa. Difference between actual and expected pricing, difference between actual and expected unit sale, difference between overhead costs, incurred labor costs, and the material costs. And we can look around the example here, 2000 units and sales were 15,000 in a year, and fixed costs were 100,000. Observed rate, the absorption method, which we can say, the variable cost per unit 3 and the material 2. These are all variable cost, labor and material total is 5, the sale price per unit 20, commission 10%, and additional sales cost incurred 5,000. Calculate the profits. We can say marginal cost values of inventory 5. We can look around total average cost inventory is 10. And when calculating the budget, don't forget the variable selling cost and all these, the marginal cost is the cost of every successive additional unit, which we call marginal cost. Anyone, any questions, please? And total marginal cost, we add them. So let's we look, how many units we are producing and selling. So 15,000 units, the selling price 20. So that's your opening stock. If you're starting a new business, you don't have the previous stock. Production cost is how much cost, labor, material, and all of this. How much is the closing stock? So you sold it 15, you make it manufactured 20, so there is a 5,000. The production cost was 10, so it's left, the 50,000. So the cost of the unit sold is 50,000. So you have a gross profit 10,000, less the selling and admin 35,000. So net profit is 150,000. When you're using the marginal cost mean all the variable costs, and fixed cost we use as a periodic cost. We can say £5 is a variable cost per unit, 20,000 units. The inventory is 5,000 units. So contribution, which is mean gross profit 195,000. Then you have a fixed cost and any other fixed cost. So we minus those, and then we have a profit. So you will see the profit under the marginal costing is 90,000. Under the absorption costing was 115,000. So under the absorption costing, your profit is higher than the marginal costing. So what caused 25,000 different on? So the inventory, because inventory we observe the fixed and variable cost there. Another method we look the only variable cost. That's the reason the marginal and absorption costing. Alternative, we just ask the calculate the contribution, and we don't need to produce the formal income statement. We can calculate the contribution. Contribution is different between selling and variable costs. So sale price minus variable cost equal to contribution, and then times by how much unit you're selling, you can find it. So advantages, yes, we can do CVP, cost volume profit analysis, net profit, consistent with the standard, easier to estimate the cost and management. So that's all which we discussed today lesson was heavily focused on looking the contribution, looking the cost and the costing, and this huge impact on the business. So we need to be guys make sure zero-based budget. Budget is any budget, whatever you will use or calculate the budget. First is based on the sale forecast. So your sale forecast is right, your budget will be right. That's really we need to be focused. Okay? Because all budget is based on you can prepare cash budget, you can prepare the labor, production. Yes. all these budgets, and we can find the variance and we calculate. Thanks for attending to the lesson, and the next lesson we'll go through LO3, and hope I'll speak you all during our next lesson. Thank you. Have a lovely weekend. Thanks. Bye-bye.